real quick, let's just discuss what the agenda is so you guys get some perspective as to kind of how I approach the market. And the first thing that we're going to do before we get into some charts, I'm going to show you guys just some real basic stuff when it comes to technical analysis, some simple principles. It's nothing fancy, but it'll help you understand the way we approach certain markets once we get into that. I'm going to show you the top-down approach and really how we start by looking at the world from a bird's eye view and looking at everything globally and working our way down to the individual sector level and then ultimately the individual stock level. And by going all over the world and seeing what's happening globally, looking at every sector in the U.S., looking at every country in the world, you start noticing certain themes. And we're going to get into some of those themes that we've noticed throughout the past year and some of the stuff that we're actually seeing right now. Something that I think is important to touch on is what we're seeing in the banks, particularly European banks. I think that that's really the key moving forward for this market. We'll get into some precious metals. I'll give you a quick little tour of AllStarCharts.com, and then we'll finish up with what I think is my favorite trade, in the market today. So, my attorneys, get very happy when I show this slide. This is really just to reiterate that nothing that you guys see here from me, this isn't any sort of solicitation to invest in any kind of hedge fund, whether I manage it or not. These are not buy and sell recommendations, so before you go and act on anything that we discuss, just make sure that you've run it by your financial advisor and your accountant, and just make sure that you're suitable to be doing some of the things that we're discussing. So, again, this is only for information and educational purposes only. I know you guys know that, but again, just wanted to reiterate that. So, all right, let's get rocking. So, technical analysis, right? When you think about technical analysis, you hear it all. Everybody has their opinion of what it is. But at the end of the day, really all technical analysis is the study of the behavior of the market and market participants, you and I, right? If there are more buyers than sellers and the buyers are being more aggressive than the sellers, guess what, guys? The price is going to go higher. And vice versa. If there is an overwhelming amount of supply relative to demand, if there are more sellers than buyers, the price is going to go lower. This is the case for stocks, bonds, ETFs, commodity futures, currencies, and these technical principles that we're going to discuss can really be applied across the board, right? And how you go ahead and then execute really depends on you. So I'm not going to pretend that I have like this secret formula to teach you how to be the greatest options trader in the world. I'm not going to do that. A lot of people do, and I find that to be a very easy way to lose money. I think that in certain circumstances you want to be in stocks, and in other circumstances you want to be in options, and I think in some instances you want to be in ETFs. So I think it really just depends on the market environment how to best execute that. And using this top-down approach and looking at the market globally and breaking it down to the individual stock level, at that point, based on your specific risk parameters and time horizon, you can then decide how to best execute that trade, right? So if we want to be buying gold, there are a million ways to do that. You could buy the gold futures. You could buy the gold ETF GLD. You can be in options out of those. Again, it really just depends on who you are. So I don't want to classify ourselves as stock traders, futures traders, options traders. We are traders and investors, and those vehicles out there can all be used together. It's not one or the other. It's everything combined. So just wanted to reiterate that, and we want to talk about diversification, right? When I have conversations with people, it's like, well, JC, my portfolio is super diversified. I've got energy and I've got financials and I'm hedged because I got some utilities, right? But in reality, all of those sectors and all of that exposure, those are all just U.S. stocks, right? So here we're looking at a correlation matrix where you have all 9 of the biggest S&P 500 sectors on the x-axis and all of them on the y-axis as well, and really comparing the correlations to each other. So the more green you see here, the closer it is to 1, the more that these particular sectors and stocks move together. Notice how there's a lot of green on this screen, and there's a very simple reason for that. It's because these are all U.S. stocks and sectors, right? Now, when you talk about diversification, Notice how this matrix is the exact same thing. There's a lot less green here. There's a lot more orange and gray, and that's because rather than having U.S. sectors compared to one another, we have 20 different countries on the x-axis, 20 different countries on the y-axis. And the reason I show this is just to simply so you guys can visualize how important it is to look outside of the United States borders or the borders of whatever country you live in specifically, to really have diversification in a given portfolio. So I want to reiterate how important that is to really accomplish that diversified goal. So I hope that does the trick. We don't want to treat Apple any differently than we would crude oil or regional banks or Microsoft. At the end of the day, or wheat futures, at the end of the day, these are all just securities. It's all letters and math, right? So we don't want to get emotional when it comes to a given stock, like Apple or Tesla, and get emotional about who the CEO is and what's going on behind the scenes. At the end of the day, we really don't care about any of that stuff. It's really just understanding the supply and demand dynamics of a given security. And the beauty of technical analysis is that these tools can be applied across the board. You don't need to be a technology expert or an energy expert, right? Or an expert on Greek debt. It's all just letters and math, and the principles that we have can be applied across the board. So just want to reiterate that before we get into these principles. So, all right. So this, guys, to me, this is supply and demand 101. This is, if you guys want to hop out of here after this, this is, by all means. I mean, if you take anything out of this presentation, I think it should be this. This is really where it all begins. This helps to set price targets. This helps to manage risk. This helps to get entry points. This, by far and away, is the most important thing that we're going to discuss today. And all it really is that former support turns into resistance, and I think a lot of us here, are probably familiar with that sort of thing. So let's get into it real quick. So let's just call this blue line the price of Microsoft, and let's call this red line, support and resistance. So every time Microsoft gets to 40, and by the way, this is just a hypothetical situation, so this is an actual price, actual prices. We're just keeping it simple so you can understand. So call this $40. Every time price gets to $40, Microsoft starts to rally, right? Ultimately, the more times that a level is tested, the higher the likelihood that it's going to break, right? So the reason it's been holding and bouncing at these levels is because there is an overwhelming amount of demand relative to supply. In other words, there are more buyers than sellers at $40 for whatever the reason. It could be an institution that consistently has their bid there. Who knows? It could be options traders that are hedging through the equities market. But for whatever the reason, $40 is key support for Microsoft. Let's call this throughout a 6 to 12 month period. And then ultimately, the more times that a level is tested, eventually it's going to break, right? So it breaks down. And when it breaks that support, that is the market suggesting to us that at that $40 level, where there were more buyers than sellers, where there was once more demand than supply, is now the opposite. Now the supply overwhelms the demand. The selling pressure at $40 now overwhelms the buying pressure, right? That's the market breaking, quote unquote, support. So if we know that that support is broken and there are more sellers than buyers at 40, on any kickback to 40, we know that the sellers dominate that price, and that's why former support turns into resistance. Where demand once overwhelmed supply and that breaks, now supply overwhelms demand. So I hope you guys understand that. Very simple stuff, and it works in both directions, right? So again, let's just call it $40, flip it right upside down, and let's call this blue line the price of Microsoft. Every time price gets up to that $40 level, it sells off. Why? Because there's an overwhelming amount of supply relative to demand. There are more sellers than buyers at this $40 level, regardless of the reason. So every time it gets up to that level, prices roll over because, again, more sellers than buyers, right? The more times a level is tested, the higher the likelihood that it's ultimately going to break. And in this case, Microsoft breaks through 40. So that's the market suggesting to us that at that $40 level, where there was more supply than demand, where there were more sellers than buyers, is now the opposite. Now there are more buyers than sellers. The demand overwhelms the supply at $40. Again, for whatever the reason, right? So once we break out, any kickback and return to 40 is met with more buying than selling. The market has already suggested that to us. So again, former resistance turns into support and vice versa. Very important concepts to understand. So obviously, Mr. Market doesn't like to make it very easy on us, so it's not always that simple, right? And, you know, I've read a lot of technical analysis books, you know, probably 30, 40 of them over many years, you know, over a decade span. And I've read a lot of different technicians, and, you know, I'm friends with a lot of technical analysts. I am a chartered market technician. I was the former chapter chair of the New York City chapter of the Market Technicians Association. So, you know, some of my best friends in the world are some of the best technicians on earth. I mean, there's no doubt about it. And, you know, for the most part, you know, there are a few exceptions, of course, but for the most part, I've kind of noticed that failed breakouts, and also called whipsaws, is something that market participants and technicians in particular are kind of weary about it. It's almost like, you know, okay, we want to buy the breakout, but be careful that it might be a failed breakout, right? It's almost like it has a negative connotation, like a failed breakout would be a bad thing. I would argue, and I've been arguing for many years and, you know, through many successful trades, that these failed breakouts are a blessing. It's something that we should look for, because from failed moves come very fast moves in the opposite direction, okay? So in this case, again, let's just keep it simple. Let's call this Microsoft at 40 bucks, right? Every time it hits this 40 bucks, prices sell off, prices sell off, prices sell off. Eventually, prices break out, right? We make a new high, new 52-week high, new all-time high, whatever the case may be, but we are now above all of this former overhead supply. Then you have your, you know, 26-year-old journalist at media outlet du jour, who has no idea why prices are making new highs, just looks to see whatever headlines might make sense to justify this new price change. So in some cases it might be an earnings release, there might be a merger, who knows, but they blatantly make up a reason for prices making a new high. And then what happens? Anybody waiting for the breakout buys the breakout. Anybody who is short against this level, in other words, saying, okay, I'm going to be short Microsoft as long as it's below 40, but if we get above 40, all bets are off, right? So what happens? You get the new high, you get the sexy headline, all the buyers start piling in on the breakout, anybody who is short gets stopped out, right? Then a couple of days later, a couple hours later, depending on the time horizon, prices start to roll over and get back below 40. So now what happens? Anybody who bought the stock on the breakout is now wrong. Anybody who got stopped out of their short is now no longer short the stock and is seeing prices falling, you know, and have that FOMO, have that fear of missing out because they are right, but they're not in the trade. So in order to unwind these trades, anybody who bought the stock on the breakout and is now wrong has to sell that stock to unwind that position. And then anybody who was short the stock and got stopped out now needs to re-short the stock to get back in that position. So then once you start seeing all of this renewed selling, then that's when the momentum players come in. That's us, the ones that recognize what's going on here, which we start piling in, and then that creates even more unwinds of wrong trades. The new longs that have to sell, the shorts that got stopped out have to cover, have to re-short the stock, right? And that brings even more momentum players, right? And then whoever wrote and blatantly made up the headline for the new high is now nowhere to be found and is now making up headlines for other stocks making new highs or new lows, right? So that is why from failed moves come very fast moves in the opposite direction. And we're going to go over a couple of tools now to try to recognize when these are taking place. And, you know, members of AllStarCharts.com obviously, you know, can see all of that. We'll walk through it in a minute. But from an execution standpoint, this is a very simple trade. You enter it right when it gets back below 40, right? So you get the breakout above 40. Let's just say it goes to 41.5, 42, you know, 40.5, whatever the case may be. Once it starts breaking back below 40, that's where you enter. 39.90, 39.85, something like that, right? And then you set your stop back above 40. So what's the risk? 15, 20, 30 cents? But the potential reward is many times 10 times that, right? So the idea here is to constantly position ourselves in favorable risk versus reward opportunities because, remember, we're not here to be right. We're here to make money. So this is one of the entry points that creates risk-reward opportunities that are very much skewed in our favor, right? And that's what we want. And it works in both directions, guys. From failed breakdowns come fast moves higher. And, you know, same thing. Let's just call it 40 bucks. Support, 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 break, right? So now you get the headline. 26-year-old journalist blatantly making up a reason for a new high, for a new low. All of the short sellers that had been thirsty this entire time pressed their shorts. Anybody who was long above this level and said, okay, I'm going to be long as we're above 40. But if we break, all bets are off, right? So they get stopped out. So what happens? A couple hours later, a couple of days later, prices start getting back above $40. Anybody who shorted on the break is now wrong. To unwind that trade, they have to buy the stock back. Anybody who got stopped out of their longs is now no longer in the trade. To get back in, they have to buy back the stock. Then the momentum players come in. That's us, right? So we start piling in, which creates even more shorts that have to cover, which creates even more longs that got stopped out having to buy it back, which brings in even more momentum players, and that unwind just really gets going. And that's why from failed breakdowns come squeezes higher. And the execution is the exact same thing. Once let's just say we break $40, we head down under 39, 38, whatever it is. A couple of days later, we get back above $40, right? You're buying it at 40.10, 40.15, 40 and a quarter, and you put your stop back below 40. If we break below 40, all bets are off. What's the risk? 15, 20, 25 cents, but the potential gain is 10, 15 times that. So again, it's not about being right, it's about making money. And if we can find the opportunities like this, and by the way, they happen constantly, which is why I'm showing them to you. This is gold miners in January, by the way. Gold miners made new all-time lows in the GDX. A couple of days later, got back above $13, and they doubled from there. So members of AllStarCharts.com, and I know there's some on this webinar, so you guys can attest. And obviously, if you follow me on Twitter or StockTwits at AllStar Charts, we were also talking about it at that point, being long gold miners only above 13. You know, it's amazing because this slide is one that I've kind of been using for educational purposes and whatnot for many years, but well before this January for sure, and gold miners GDX looks exactly like this. Fantastic. Here's another great example of that. This is actually United States Treasury Bonds at the end of 2013. Very simple. Support, 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 break, right? Then you get the silly headlines. At this point, this is TLT, so this is U.S. Treasury Bond ETF. 64 of 64 Wall Street economists were polled and asked where interest rates were headed. And all 64 of them here at the end of 2013 said that interest rates were going higher, so sell bonds. So Wall Street economists right here on this failed breakdown told you to sell bonds. And then what happened? From failed moves come fast moves in the opposite direction. Not only was selling U.S. Treasury bonds and listening to every single Wall Street economist, by the way, not a good idea, but U.S. Treasury bonds over the next year, it was one of the greatest years in the history of the U.S. Treasury bond market, and this is a market that we've been trading for over 200 years. So, you know, again, that those unwinds from those failed moves can be extremely powerful, and I think this is a great example, and gold miners in January, another great example. I could sit here all day giving you many more, but I think you guys get the idea. And it's not just like, oh, this one pattern of a descending triangle or a rising wedge or whatever it is that you want to call it. It's not that it's just one pattern. It's technical analysis in general. It's pattern recognition in general that often fail, and patterns failing is not a bad thing. That's a good thing. We want to be able to recognize that. And some people are like, oh, technical analysis doesn't work because, you know, this pattern didn't lead to this. No, that's because your conclusion was wrong, right? Your technical analysis was wrong, not that technical analysis in general was wrong. Your conclusion was wrong, right? All technical analysis is the study of the behavior of the markets. If your conclusion based on your studies is wrong, that's on you, not on the market or the or the practice itself, right? So here we're looking at a head and shoulders pattern. It's very popular, probably because it has a silly name, but in reality, it's actually a very rare occurrence, because by definition, head and shoulders patterns are reversal in nature, and markets, by definition, trend. So by looking for these big monster reversals, you're essentially defeating the entire purpose of what we're trying to do here in the first place, which is recognize trends, right? So a lot of times what you'll see is these head and shoulders patterns might appear, but in reality, they're really just not. They're just continuation in nature. So, the book says you have a left shoulder where you have a new high, then you have a head, which is an even higher high, but then on the third attempt to make a new higher high, it fails to do so, and puts in a lower high, right? And that's where you get the shoulder, the head, and the right shoulder, right? And then the support down below is what is called a neckline, or referred to as a neckline. But all it really is a support level in the same way that this was support, in the same way that this was support, right? Just because it's a head and shoulders pattern doesn't change that, right? Same principle. So the book says short the stock or the commodity or the currency or whatever it is on the break. Let's call this Microsoft at $40, right? Just to keep the theme going. Prices break below 40. A couple of days later, it gets back above 40. So what happens? Anybody who shorted the stock is now wrong. Anybody who was long and got stopped out when it broke 40 is now no longer in the trade. So anybody short has to buy it back to unwind that position. Anybody who was long and got stopped out has to buy it back to get back in the trade. Then the momentum players come in. That's us, right? Which creates even more shorts that have to unwind their positions, and even more longs that got stopped having to buy it back. And that's why from failed moves come fast moves in the opposite direction, right? The oops, and we see this constantly all the time. Here's just just an example off the top of my head. This is a head and shoulders pattern in the summer that apparently was being completed in the summer of 2010. And I use this example specifically because I remember I was at my friend's office and CNBC was on, and not to pick on CNBC, I have a lot of friends that work there. I just happened to remember Sue Herrera, and again, not to pick on Sue Herrera, I'm sure she's a very nice lady, but on the break of this support, Sue Herrera comes on live television and says, well, that's the head and shoulders pattern has officially been completed. So that means stocks are going lower. So now you have a journalist on a television network proclaiming to be a technical analyst and suggesting that the market is going lower. And this was right here in June of 2010, and we all know what happened after that, right? So again, from failed moves come fast moves in the opposite direction. You want to, and when these sort of things are happening, you really want to really start getting a gauge for sentiment for this particular security, and in the case of the Wall Street economists, when it comes to Treasury bonds, and the example I showed, when it comes to, in this case, the S&P 500, the media was obviously extremely wrong. So the last thing that I want to talk about is momentum, and this is really one of the ways that we can recognize when these potential moves are really setting up. It's a supplement to price. So I look at a relative strength index, a 14-period RSI, not to be confused with relative strength, right? Relative strength is when you're comparing one security versus another. So if you want to know the relative strength in financials, for example, it's financials sector relative to the S&P 500, for example, right? If you want to know how tech is doing on a relative basis, you want to do like an XLK relative to SPY, right? When we talk about the RSI, all we're talking about is a measure of momentum, okay? So when I say period, if we're looking at a weekly chart, it's a 14-week RSI. If we're looking at a daily chart, it's a 14-day RSI, right? So the market is fractal. We're using the exact same time horizon regardless of the period. And it's an oscillator, which I know is a fancy word that I can barely spell, but all it really means is that the indicator moves from 0 to 100, okay? So when you hear oscillator, that's what that means, okay? So when it moves from 0 to 100, traditionally, overbought readings would be above 70, oversold readings would be below 30, right? So when markets are in a range, and this is one of two ways that I use momentum, right, in a very simple way. If you look at RSI in a chart, and we are in an uptrend, okay, the way RSI behaves in an uptrend is that in rallies within an uptrend, momentum will get overbought. RSI will get above 70, hit 80, 85, whatever the case may be, but would consistently get above 70. However, during corrections within strong uptrends, right, because nothing goes straight up, everything, it's higher lows and higher highs, right? On the higher lows within an uptrend, momentum does not get oversold. momentum stays above 30. That's what a bullish range looks like. So if you're seeing consistent overbought measures and you're not seeing oversold conditions, that's very positive, right? Sometimes you hear how, oh, I don't like the stock because it's overbought. Overbought is a good thing, guys. How is an overwhelming amount of buying a bad thing? Right? So think of it like that, right? So that's one way to do it. And by the way, the strongest uptrends stay above 50 in RSI. Then on the bearish side, when you have a downtrend, you're making lower lows, lower highs. And when you get lower lows in price, momentum gets oversold. It gets below 30, 25, 20, whatever the case may be. But on counter trend rallies, within strong uptrends, momentum fails to hit overbought conditions. It never gets above 70. And in the strongest downtrend, guys, momentum tends to stay below 50. So this is just one simple way. Pull up RSI, 14 period on your chart. There's not much thinking going on. You can just take a quick glance, be like, boom, uptrend, boom, downtrend. Or, this thing's all over the place. We're hitting overbought and oversold conditions, so it's not for me, right? So when it comes to trend recognition, guys, recognizing an uptrend, recognizing a downtrend, or recognizing that there's no trend at all is also trend recognition. And oftentimes we don't have a trend. So and currently in the U.S. stock market, I think it's a good example of a lack of trend, and we'll get into that in a minute. So the second way that I use momentum, guys, and this is the last thing that we're going to look at, is think about a tennis ball, right? Throw a tennis ball up in the air. That momentum is going to start to slow down before the tennis ball hits its peak, right? And you could recognize that slowing of momentum before the ball tops out, if you will. It's the same thing in the market, right? There are tools where we can recognize that momentum is slowing down before price hits its peak. So in this case, we have two lines plotted. Up at top is the price, right? Just the price of anything. It doesn't matter what it is. And then down below, we have the RSI. And when prices are making higher lows and higher highs, you want momentum also making higher lows and higher highs, and particularly higher highs. However, when prices make a new high and momentum fails to do so and puts in a lower high, that's what we call a bearish momentum divergence. And that's a signal that the trend is changing. Not necessarily reversing, but certainly changing, right? So that's what we call a bearish momentum divergence, and it works in both directions. In a strong downtrend, prices are making lower lows. Well, you want to see momentum making lower lows as well. If prices make a new low and momentum puts in a higher low, that's what we call a bullish momentum divergence, and it's a signal that the trend is changing, not necessarily reversing, but again changing. In this particular example, this is actually silver in the summer of 2012. July, I believe, was the new low. Momentum put in a higher low. Silver stabilized, flattened out for a little bit, and then went on to rally for 6 months. So although it didn't reverse right away, it changed from a downtrend to a sideways trend and then to a new uptrend. But had you been following momentum, you'd know that there had been no reason to be short. Maybe you wouldn't have gotten long yet, but there was definitely no reason to be short. So we use these divergences not just to initiate new positions, but to get out of current ones or older ones, right? Okay, so let's get into some charts. So here's the reason that we've been structurally bearish or out of the market since, structurally since last summer. Although at the end, we'll get into in a minute, at the end of January, early February, we got extremely bullish for a counter trend rally. And in August, we were covering short positions. So although tactically we were doing bullish things, right, covering shorts in August, covering shorts in January, getting long in early February, those are just tactical moves. Structurally speaking, there's been no reason to be involved in the market, right? So when it comes to a top-down approach, we start with weekly time frames. We want to get a big picture idea of what the market is looking like and what it's doing, and then work our way down to the individual, more of a short-term tactical basis, right? So when we say structural, we're looking out quarters and years. When we say tactical, we're looking out weeks and months. Okay. So first, we're looking at the NASDAQ 100, and I see very simple. We ran into the highs from March of 2000, and we have been selling off ever since. It took 15 years for the NASDAQ composite to get back to where we were 15 years ago, and to assume that we're just going to rip right through that, I think would be irresponsible. So structurally speaking, there's been no reason to be long the NASDAQ. Here we are looking at a monthly chart, same thing, broken uptrend, bearish momentum divergence. Meanwhile, the S&P 500 is hitting the 161.8% Fibonacci extension of the entire 2007 to 2009 decline. And we have a finite amount of time in this particular presentation, so we're not going to get into Fibonacci. But if you guys email me at jc@allstarcharts.com, I'm happy to send that out to you. But the point of the matter is, there's again no reason to be long the market. Meanwhile, the NASDAQ composite was also, just if you simply use trend recognition, there was no reason to be involved. And I'm getting the word that we actually only have 10 more minutes, so I want to get to a couple of interesting points that I see today. And if you guys, since we're not going to be able to get through every single chart, if you guys want the slide presentation, I'm happy to send it to you. Just send me an email, jc@allstarcharts.com, and I'll send you all of the charts. But I wanted to discuss real quick the internals of the market. One of the reasons that we were getting bullish at the end of January and early February was because of the internals of the market, right? The market here's the S&P 500, and here are the list of stocks on the New York Stock Exchange making new 52-week lows. So on the new lows in January, look at the amount of new lows that were made, right? And then on the new lows in February, we had half the amount of lows on that list. So the internals of the market were already improving before the market itself made its bottom, and it was one of the reasons we got very bullish. At this point, however, the list of new highs on the New York Stock Exchange continues to deteriorate. Notice how every spike in new highs is a lower high. So until we start to see an expansion of breadth, we start seeing more new highs, I think we have to be skeptical. One thing I will note is that the NASDAQ actually, we did get a new spike in the NASDAQ of new 52-week highs. We had the most amount of highs since last summer, right before the market fell apart. But nonetheless, we did get an expansion of breadth. Here's the New York Stock Exchange advanced decline line running into those 2014 highs. This is the common stocks only AD line, and there's trouble up ahead. So until we can start clearing this 10,400 level in the advanced decline line, I think we have to be somewhat skeptical. Very simple, guys. This is a downtrend in the NASDAQ composite. Lower lows, lower highs. This is a downtrend until that changes. Same thing with the S&P 500. Lower lows, lower highs. That's a downtrend until something changes. If we start to put in higher highs, that's another story, but come talk to me then. In the meantime, neutral to bearish is definitely best. And finally, I want to show you guys the we take sentiment very important. I think the first slide I showed you guys was, the technical analysis, the study of the market and market participants, right? Us, what we're doing. So Consensus Inc. Publishes the amount of bulls in the S&P 500, and we are actually at 72% bulls towards the S&P 500. Last time the market was this bullish was last year, last summer when we were at, it was actually the beginning of June, we were at 71% bulls, and the market completely fell apart after that. So we are at the most optimistic levels since then. So guys, I wish that we could really get into these. I have a bunch of charts to show you, and unfortunately, we just don't have the time. But again, I promise you guys, if you email me, I'm happy to send you. The slide deck. So there's a couple of charts that I just wanted to touch base real quick that I think. So to me, guys, this is really the key for the market. It's European banks, okay? If the stock market is going higher, I'm not just talking about the U.S. markets, but globally, if there's real risk appetite for stocks out there, this chart needs to stop crashing. This is the Dow Jones European financials relative to the Dow Jones U.S. financials. In other words, European banks versus U.S. banks, and it's still crashing, okay? Until we start to rally in this ratio, I can't see a scenario where there's enough risk appetite for stocks to send the market to new highs. So you want to see stabilization in this. Here are European banks on their own. Broken up trend, looks very continuation in nature. I see no evidence to suggest that European banks have bottomed. Credit Suisse has had every opportunity in the world to put in a bottom, still has not. So if we start to make new lows in Credit Suisse, it's a stock we want to short. In the meantime, it's neutral, but one we want to look to short in the near future. If we break the lows from January in Credit Suisse, it's a stock we want to short. Same thing with Deutsche Bank. The longer it stays down here, the more bearish this becomes. If you're a stock market bull, you need Deutsche Bank to get back above the 2009 lows. Otherwise, you're looking at Deutsche Bank trading in the single digits. Here are European banks relative to the European stock market. This is an area where you want to see leadership. It has been the exact opposite, just on a relative basis, European banks just getting destroyed compared to the rest of the market. If we start to roll over and make new lows below last year's lows, I think the European banks are in trouble, and that's going to be tough for the overall market. Real quick, just when it comes to interest rates, I think that, here, let me show you guys real quick. When it comes to interest rates, here's the 10-year yield in the U.S., and we're basically just consolidating in this range and really completely in no man's land. But you want to put things in perspective. The real story here is the yield curve, guys. These are 10s minus 2s continuing to narrow. And if things were so hunky-dory in the market globally and those real risk appetite, we would not be seeing this curve narrowing. We just closed at the lowest level, the most narrow net level in 10s minus 2s since 2007, guys. By the way, same thing in the 30s minus 1s. These aren't old charts. These were new lows this year. If the yield, I'm still in the camp that the yield curve is going to invert, and if that's the case and we get below zero like we did in 2006, I think that would be very negative. An inverted yield curve has preceded every single U.S. recession since 1960. So I think it's definitely one worth watching. I wanted to get into gold and silver. We want to be neutral. All upside targets have been hit. However, bigger picture, we're seeing trends in gold, particularly in other things, gold versus copper, gold versus Canadian dollars, really breaking out. So before I get into my favorite trade right now, let me just give you a quick walk through AllStarCharts.com. You guys have access to a chart book. The chart book has over 350 charts, which in a couple of weeks it's about to be over 500 charts, which include all of the global indexes around the world, every single U.S. sector, all 30 Dow components, all of the intermarket charts that we just kind of went through, all of the commodities, right? Not just gold and silver, not just oil and natural gas, but corn and coffee and cocoa. And all of these charts are on a daily time frame and on a weekly time frame so that we can get structural perspective on a weekly chart and then break it down to a daily chart to get a more tactical perspective, right? And here's just an example of Apple. You'll have the chart annotated with my with my key levels and why, in this case the 2012 highs or the September of 2012 highs, and then my notes in terms of how we want to approach this particular market. Then every week, when we just sent one out last night actually, or actually was sent out this morning in fact, it's a weekly letter where we go over the entire market, and in that case, I'm not limited to 45 minutes, and we could really get into it, talk about U.S. stocks, talk about U.S. sectors, individual stocks that we like or don't like that we want to be buying or shorting, get into the global markets, what that's telling us, what we're seeing in Brazil and other emerging markets, for example. Then we get into the commodities markets and what we're seeing in metals or energy or agriculture. We've liked agriculture a ton over the last couple of months, and it's really been working for us. Once gold and oil hit our targets, we've seen that rotation into commodities. So I think it's something that we need to watch. So you get that weekly letter really explaining all of that. Then we have the trade ideas, guys. We've gotten feedback from members that sometimes the research can be overwhelming because there's just so much material and so much data that we provide for you so that you can get through it. So in order to just keep it more organized and just give yourself a reference point, we have every single trade idea listed in the trade ideas page. And then finally, our members, our favorite part, my understanding from the feedback that I've gotten from our paid members, is the monthly conference call, right? It's something kind of like this, except rather than going over momentum and Fibonacci and some of the principles, we get right into what the market is looking like right now, what we like, what we don't like, why it is, and I try to spend 20, 25, 30 minutes going through that, and then I just open it up for questions over the next 30 minutes, and we just talk about whatever you guys want to talk about, right? And we have a members forum where you can introduce yourself, share ideas, some of the things that we're talking about as well. And finally, after all of that, trade ideas page, the weekly letter, the monthly conference call, if you still have any questions at all, whether it be regarding something I may have said in a call or in a letter, or perhaps something that I haven't discussed, maybe a stock in your portfolio that you want to know my opinion about, feel free. Email me, and I usually get back to you within 24 hours and normally quicker. So I think this is one of the best features that we have. So normally we have a quarterly membership. It's only $397 a year. A quarter, and $12.97 for the entire year. But today what we're going to do is we're going to knock that off, right? So, our friends invited us here. So, Investor Inspiration was nice enough to invite us over here to kind of just talk a little bit about market education and whatnot. So we're going to knock this off. $297 for the quarter, $997 for the year. You can go to allstarcharts.com/profits in order to get this discount, and it includes the chart book, the weekly newsletter, all of the actionable trade ideas page, the monthly conference call, the members-only forum, direct access to myself, and most importantly, it's a 30-day risk-free trial. So you are guaranteed your money back if you are not 100% satisfied for any reason at all. So you go to allstarcharts.com and you can go in there, and I'm going to put in the put it in right here in the chat, allstarcharts.com/profits. Okay, and you can go to allstarcharts.com/profits. It expires Sunday night at midnight, guys, so take advantage. Start your risk-free trial. You go to allstarcharts.com/profits, you click the button, and it takes you right to the page to go ahead and sign up. As you can see here, you enter it, boom, and you're done. Here's Howard Lindzen, monster hedge fund manager and venture capitalist. JC looks at the markets in different ways than I do. He lives and breathes what I call chart art and relative pricing. Most importantly, though, he makes me money. Thanks, Howard. So, without further ado, here are some some other testimonials that I'm happy to present. I'm not going to read it to you because we don't have that much time, but I think you get the idea. Our members are happy, and there's a very good reason for that, because if you're not happy, you get your money back, right? So we only have members who are happy, so we're happy to say that. So guys, my favorite trade right now, very simple, okay? We want to be short gold and long of silver, okay? Here we're looking at a ratio of gold versus silver. This is a historic chart. Every time this chart gets above 80 to 1, in other words, gold is priced at 80 times the price of silver, the ratio crashes, right? We see this time and time again. Our members have been advised to be short for several months now, so it continues to work, and I still think it does. We want to, for every dollar that we are long of silver, we want to be short $1 of gold and take advantage of the narrowing of the spread, and we want to be covering our positions when we get down under 50. So I think we have a long way to go. Here is this exact same ratio, okay? And it's a more short-term chart. Notice how we touched the uptrend line from the 2013 lows. Momentum hit oversold conditions because it is in a downtrend. And I fully expect that we ultimately break down below this uptrend line and we head down under 50. So we want to be long of silver, short of gold in order to take advantage of a narrowing in this spread. So guys, I'm going to leave this up. Again, allstarcharts.com/profits. Okay, it's a 30-day risk-free trial. Okay, it's $297 a quarter, $997 for the year, and the offer expires Sunday at midnight, guys. So allstarcharts.com/profits.